Today we're going to talk about two different topics, one being housing and the other being inflation. First, let's talk about housing because a lot of people have been texting me asking what to do with their house because we are in a new environment where interest rates are rising fast and we know that affects home prices. So we're going to talk about it because I know it's a big question, but the first thing I want to say is that it's okay if your house isn't an investment. This is what people forget when they get too caught up into this investment sphere with all these YouTube videos talking about housing and real estate and all these articles that always come out, personal finance in general. But let's take a step back and think realistically here for a second. A house is where you live. It doesn't have to be an investment. And again, a lot of people will stress you out about it, saying you should do this, you should do that, you should sell now, buy now. But just keep that perspective. You live in your house. You raise your family in your house. That's what a house is for, more than being an investment. And even the debate of buying versus renting, both are fine. If you want to buy, buy. If you want to rent, rent. And don't feel guilty about either, and don't let anyone make you feel guilty about it. Me, for example, I rent. And that lets me get in and out of places real quick when I need to. I was out of my last place in a few weeks. Made a decision on the Monday, and the following 2 Mondays I was out. And I was done. Didn't need to sell anything. It was real easy. I like the flexibility. Even though I got so many people telling me how I'm throwing money away. Doesn't matter. I like the flexibility and I like where I live. So that's my caveat when we're talking about housing. Now, Ben Carlson here, he's a wealth advisor. I think he actually lives in Michigan too. But he gets the same kind of questions too. Like a reader recently asked him, is there a way to hedge the price of my home? Because it's appreciated a lot over the past couple of years, and my hunch is that the value will pull back in the coming months. I had a similar hunch about interest rates a year ago, and there are products to bet on treasuries selling off. This year, the no-brainer trade is housing prices dropping. How do I play it? Now, the housing market is in for a huge shakeup, and it's really interesting when you look at the numbers. Because at the beginning of 2022, the 30-year mortgage rate was around 3%. And as of a few weeks ago, it has now jumped to 6.3%. So in less than 6 months, one of the most important borrowing rates for the US economy more than doubled. That has a huge impact. And you know, Powell in his last meeting, he said that home buyers need a bit of a reset. Well, a move from 3 to 6% in the interest rate, that would exclude 18 million households from qualifying for a mortgage of $400,000 because it's too expensive. So that's a reduction in potential demand of 36%. And this all happened in 6 months. That's a huge move. And when we dig deeper into the math, you see how problematic a rise in interest rates is. So think about it this way, a $500,000 house, and this is assuming a 10% down payment, so that $500,000 house with a 3% mortgage has the same monthly payment as a $340,000 house with a 6.3% mortgage. That's how big the difference is. Between $340,000 and $500,000, the payments become the same because these interest rates doubled. So in January of 2021, the median existing home price was $313,000, while mortgage rates were 2.7%. So again, assuming 10% down, this was a monthly mortgage payment of $1,140. But house prices are much higher now. So the median home price is closer to $400,000. And at a 6.3% mortgage rate, that's a monthly payment of more than $2,200. So housing prices are up 20%, but monthly payments are double because of what's happened to the interest rates at the same time. So you're kind of getting screwed on both sides. The house is more expensive and the interest rates payments are more expensive. So obviously housing prices are rising way too fast over the last few years, right? It was an absolutely crazy market. But at the same time, no one expected interest rates to rise this fast either. So now we're in a weird little period where we don't know exactly what's going to happen with housing. So will homeowners with 3% mortgages just never move now because it'd be such a pain? Will buyers sit things out and wait for price cuts? And will home builders stop building so many houses and make the supply shortage even worse? Because there is indeed a supply shortage. That's why prices were going up so much and why there was still so much building everywhere you looked. We talked about it in previous videos where we said that was going to happen until the millennial boom was over. And that wasn't going to happen until 2024, 2025. But this interest rate hike, that changes things now. So there is a good possibility that this leads to a reduction in housing prices, but we don't know that for sure. But let's assume that is going to happen. How would you hedge a 5 to 10% drop in housing prices? Well, you could try to go the big short route, find some mortgage-backed securities, even though there are not many. And even if they were, it's not realistic for an individual investor to build a basket of those CESs. So here's what Ben says you could do. You could take out a large home equity line of credit on your home. That way you're kind of selling high and take some cash off the table. That cash could then be used to diversify your assets or even fix up the house to increase its value. Downside here though is that you're paying higher interest rates for this privilege. But that's one way to change up your personal balance sheet if you're worried about your house price dropping. But honestly, if you take that money out of your house, where are you going to put it right now? You don't really want to put it into the market. Do you want to put it into bonds? bonds? Maybe. Those fixed income prices are still dropping though. You don't want to put it into crypto. You don't necessarily want to keep it in cash either because inflation is now really eating it away. I guess if you're sophisticated, you would throw it into the commodities market. I guess that's the only place to put it. So I don't know about that suggestion so much. Another option is to simply sell your house. But this is a tough one because again, you have to live somewhere. And downsizing may not be very appealing right now with mortgage rates so much higher and rents going up too. If you have a low mortgage rate that you locked in, it doesn't make a whole lot of sense to pay it off faster because rates and inflation are so much higher now. And the final option is do nothing. Don't do anything different. You don't have to be a hedge fund manager with your house. I completely agree. Even if prices do fall a bit, as long as you plan on living in your home for at least 7 years, the price will likely be higher in the future. That's not always true. I guess he says likely higher. But yeah, again, if you want to take some stress off yourself, remember your house is where you live. It doesn't have to be an investment. Just enjoy your house because that's where you're going to be for the next few years as we go through this recession. We can't be going out and spending money. Spend time in that house that you bought or rented or whatever. It is interesting though because these mortgage rates doubling does make it a lot harder for first-time home buyers to even get a house. And at the same time, the crazy increases in prices that we've had over the last few years, that made it hard too. The housing market is a mess. So I would hope it normalizes where even if interest rates are higher, these prices come crashing down because we do need to reset it. You know how much I've complained about private equity buying up all these homes and just all this money floating around because of the Fed manipulation. It has to go somewhere, and where it goes is into these assets that get inflated so the people who actually need to use them can't. It's a mess. And that's what recessions are supposed to help cure. They clear out all this rot. And the housing market has a lot of that rot. Make sure you put your comments down below about what you think about the housing market. And now the next thing I want to talk about is inflation. Again, some interesting stuff from Ben Carlson here. And what he explains in this article is that the stock market used to be way different in the past. How people invested was different because inflation and interest rates were different. You'll see what we're talking about here. So interest rates were much higher in the past. So that meant that corporations in the late 19th and early 20th centuries had to offer dividend yields on their stocks that were higher than bond yields. That way they could entice people to invest in those stocks. So it was real simple back then. Whenever the dividend yield on the stock market fell below the yield on bonds, stocks were too expensive and it was time to sell. And this was a pretty reliable signal. It worked in 1907 and it worked in 1929. And that's just how people evaluated stocks. Oh, are the dividends higher here? Let's buy stocks. If they weren't, let's not buy stocks, let's buy bonds. But eventually this relationship stopped working. And that happened around 1959, because at that point stock prices were flying higher and bond prices were falling. So what that meant is the ratio of bond interest, which is those interest payments, to bond prices was shooting up, and the ratio of stock dividends to stock prices were declining. So the old relationship between stocks and bonds vanished, and it opened up a gap so huge that ultimately bonds were yielding more than stocks by an even greater margin than when stocks had yielded more than bonds. And this is when the switch happened where people were making more money from stock appreciation. So it wasn't just all about the dividends. And inflation ended up being the main factor that distinguished the present from the past. Because remember, what does inflation do? It inflates prices on everything, right? That includes asset prices, and stocks, they're assets. So their price goes up with inflation as well. So from 1800 to 1940, the cost of living had risen an average of only 0.2% per year, and it actually declined on 69 occasions. In 1940, the cost of living index was only 28% higher than it had been 140 years earlier. So inflation was not crazy back in the day. And under such conditions, owning assets valued at a fixed number of dollars was a delight. It was the thing to do. And owning assets with no fixed dollar value, that was highly risky. So that's why bonds look better than stocks. And stocks, to compensate for the riskiness, had to offer those high dividends. Well, World War II and the economic environment that we got after that altered this relationship forever. Because from 1941 to 1959, inflation averaged 4% per year. Prices doubled in that 19-year period. And this environment was not kind to bond investors. So 10-year treasuries that were purchased in 1945 were worth only 82 cents on the dollar by 1959. And that was before inflation, because now that 82 cents could only buy half as much in 1959 as it could in 1949. And one of the points that he makes in this article is that this concept of inflation is relatively new, because we didn't experience it for so long, and now it's crazy. See, we're simply not used to inflation for an extended period of time. Few few people have experience dealing with the aftermath of rapidly rising prices. See, back in this period between 1915 and 1945, the average inflation rate was 2% per year, but it was above 5% for almost 25% of the time, and roughly 1 out of every 7 years saw inflation of 10% or more. But there was also deflation more than 1/3 of the time. So during that period, there was a lot more economic volatility with a lot fewer sustained periods of calm. Now, if we contrast those numbers with the 40-year period since 1982, inflation has not been above 10% even once. It was above 5% just 8% of the time, while deflation occurred in just 3% of the time. But the average annual rate was more than 3%. So there was more inflation and it was more stable inflation. And where we are now, inflation could remain elevated for some time if governments continue to spend money or the energy crisis worsens. But we could also see severe disinflation or even deflation if the Fed overplays its hand with interest rate hikes and we go into a recession, which if you've watched our previous videos, you know we likely are going into a recession. And it's interesting to think what it would mean for the Fed to actually overplay their hand because inflation is so high. Interest rates have a long way to catch up. That's what Druckenmiller was saying, right? But all in all, it's good to keep an open mind about what comes next. Here's a quote from Bernstein. He said, "The fact that something so unthinkable could occur has had a lasting impact on my view of life and on investing in particular. It continues to color my attitude towards the future and has left me skeptical about the wisdom of extrapolating from the past." And that again makes sense with what we've said in previous videos, because the current environment that we're in now, with inflation being this high and interest rates rising this fast, there's no historical analog. So we don't necessarily know what's going to happen next. And if you ask Ray Dalio, he thinks it's going to be stagflation. So another terrible period like we had in the 70s. And we just made a video about that right here. And we all know Dalio has the best view on the macro picture, even though in some cases like China, it's biased. But for everything else, pretty good. So click this video and I will see you there.